Greetings, everybody. Welcome to the weekly wrap-up. Today is Friday, December 2nd, 2022. Hope everybody's having a fantastic week out there. Not the best ending for the markets to end the week, but I think they probably finished in the green with that huge rally we had a few days ago, but definitely lost a lot of that steam over the last 2 days. So anyways, if it's your first time watching Liberty Call, please give me some thumbs up, hit the like, the share, subscribe, all those good buttons, share with friends and family. I'd greatly appreciate it. I'm sure there's a lot of folks out there wondering what the hell's going on in the economy. I try to break it down as simple as possible for the average person. So anyways, all right, well, let's go ahead and jump in and take a look and see how the major indexes did today. Dow Jones finished up 0.1%, closed at 34,429. The S&P 500 was down 0.12, closed at 4071. NASDAQ was down 0.18, closed at 11,461. Small caps are up 0.44. The VIX fell another 3.93% today. It's currently sitting at 1906. Canada's market was down 0.19. Brazil was up 0.91. Mexico was down 0.51. Headed over to Europe, Germany was up 0.27. UK was basically flat at down 0.03. France down 0.17. Same with the Euro stocks. Netherlands was down 0.1. Spain flat at 0.00. Italy down 0.26. Switzerland down 0.36. And Portugal down 1.19. Both Russian markets were in the red. The MOX down 0.31. The RTSI down 1.43. And the overnights in Asia, the Japanese market was down 1.59. Australia down 0.72. New Zealand down 0.2. The Chinese markets all red. The Shanghai down 0.29. The SE component down 0.39. China A50 down 0.61. DJ Shanghai down 0.37. And the Hang Seng down 0.33. Taiwan weighted came in, closing things out at down 0.28. So mostly reds overnight, nothing down too major, but looks like most of the trading day for December 2nd was not spectacular out there. So, all right, well, let's take a look and see how the markets did for the week. Let's start with the Dow Jones. All righty, so the Dow Jones looks like it's going to finish the week off slightly in the green at about up 0.32. The S&P 500 looks like it's going to finish off the week about 1.65 in the positive. NASDAQ, it's going to finish the week off about 1.97, so just under 2%. The Dow Utilities finished the week off up 0.75. And the Dow Transports looks like they're going to finish the week off up about 1.17%. So let's take a look and see at the longer term trend. Going back to the beginning of the year again, this resistance line has been very important. It looks like, this rally has kind of stalled here of the last couple of days. We'll see if it bounces off this or pushes through. Personally, I think it's going to bounce, quite honestly. That's just been the trend over the last 9, 10, 11 months, but we shall see. If we look at the Dow 30, it did break through this point of resistance, but it's also done that before a few months ago at the late part of the summer. So, and looking at the momentum indicator, looks like most of the steam has fallen out of this rally. So, what I would expect is probably to fall below this resistance line and then, continue the trend we've been in for a while. Granted, the Dow 30 is a lot different than the S&P 500. You got a lot fewer stocks, and they are more of your blue chips out there. All right, so that's everything that as far as the stock markets this week. Let's go ahead and peruse the data that came out over the week. Initial jobless claims came in this week at 225,000. The forecast was 235, so slightly below forecast. And again, still in line with the trends we've been in for the last few months, so that's still pretty good. Continuing claims came in at 1.608 million. Forecast was 1.573 million. So looks like about 30,000, 35,000 over forecast. First time we've been over 1.6 million since, let's see how far back we got to go. Oh, wow. Yeah, since the last week of February, or I'm sorry, the second week of February was the last time we had extended unemployment this high. But again, still pretty low historically over time. The consumer confidence gauge came in at 100.2. The forecast was 100. So, still fell from the previous month of 102.5 and 108 2 months ago. So confidence is still beginning to slip, but we'll see how that trend continues. U.S. GDP for Q3 was revised up to 2.9%. The previous reading had been 2.6. So looks like the numbers for Q3 have shorn up pretty good. A lot of that has to do with the exports of a lot of the oil that really helped our numbers for GDP for Q3. So we'll see with the ending of the Strategic Petroleum Reserve releases how that's going to affect things for Q4. The ADP non-farm employment change came in at 127,000. The forecast was 200,000, so missed that number by about 40%. So a bit off on that. The job openings and labor turnover survey job openings number came in at 10.334 million. Forecast was 10.3 million. So the we had about 11 million jobs open for a number of months going back to the beginning of March, but the numbers have started to slip a little bit. Again, not tremendously, but still is something to keep an eye on. I think the jobs numbers will start to look worse as we go into next year, as companies are having a harder time with their bottom lines. They're going to start offloading dead weight that's not productive for them. U.S. Manufacturing Purchasing Managers Index came in at a 47.7. The previous number was a 47.6. So still below the midpoint. Typically, when it's above 50, it's expansion. When it's below 50, it's considered contractionary. The U.S. unemployment rate came in this month at 3.7%, same as last month. So we've been hovering around that 3.5 to 3.7 for a number of months now, going back to, I guess, about March. Nonfarm payrolls, the report came out today, added 263,000 jobs. Again, these, like the ADP report, is slightly different from the Friday report that comes out. So they're slightly, never going to be the same. But the forecast was 200,000. Last month's number was 284,000. So slipped a little bit from last month's number, but still above forecast on that. All right. So that's everything as far as the data that came out this week, as far as economic data. Let's go ahead and read through today's market recap and see what's going on there. S&P 500 stumbles as red hot jobs report triggers Fed jitters. Ooh, don't want the Fed to be jittery. All right. The S&P 500 cut some losses Friday, but remained under pressure after a red-hot jobs report showing more than expected job gains in November and rising wage pressures stoked fears about higher for longer Federal Reserve interest rates. Again, we're not getting out of this. I mean, it's kind of like painting yourself into a corner. You're either going to have to walk across the wet paint, or you're going to have to stand there for a while and wait for it to dry. The U.S. economy racked up 260,000 job gains in November, is well above the 200,000 economists had forecast, but worrying for the Fed. Average hourly wages rose by a much more than expected 0.6%, keeping elevated inflation fears front and center. Quote, this morning's stronger than expected headline rise in employment coupled with larger than expected gain in wage pressures reinforced the need for the Fed to remain focused on taming inflation, end quote, Stifel said in a note. Treasury yields lost some steam but remained in the ascendancy as investors renewed bets on the Fed's peak level of interest rates or terminal rate rising above 5% next year. Again, I'd probably guess it's probably going to go above 6%, but that's my guess. Technology stocks were back in the firing line amid expectations for higher than longer rates, with Apple falling more than 1% to lead big tech to the downside. Well, Apple's got more problems with their iPhone manufacturing that's slumping off of late with all the unrest in China, but they may have gotten that under control. So a more than 2% wobble in semiconductor stocks also weighed on the broader tech sector as chipmaker Marvell Technology Group Limited Limited's softer guidance and weaker than expected third quarter results soured sentiment on semis. The weaker fiscal fourth quarter guidance ahead comes as the chipmaker works its way through overloaded inventory, a process likely to continue into next year. Quote, we believe Marvell is under shipping in demand in Q4 to aggressively lower customer channel inventory, a process that is likely to continue into Q1, end quote, Deutsche Bank said in a note. Banking stocks continue to lose ground, paced by more than 3% decline in Wells Fargo, following reports a day earlier that the bank is shaping up to cut jobs in its mortgage business amid pressure from Fed rate hikes that have stifled demand for new mortgages and refinancing. Northern Trust, BlackRock, and State Street were more than 1% lower. Energy stocks were dragged lower by a slip in oil prices ahead of a meeting of the OPEC Plus and this Sunday, I believe. Pointing to OPEC Plus's decision to opt for a virtual meeting rather than an in-person meeting, RBCO said the group's decision to opt out for no drama optics seemingly increases the likelihood of a rollover decision, end quote. EQT, Valero Energy, and Marathon Oil were among the biggest decliners in the energy sector. So kind of a sour note to end the week. I know everyone was really excited after Jerome Powell had talked on Wednesday, and the market really rallied off of his, I guess, dovish hint that they were going to potentially slow down the rate of rate increases. But again, until inflation really starts to drop significantly, I'm not sure why they're in such a hurry to roll up the fire hoses and call that fire out, because all it takes is a little spark and things could head the wrong way really quickly. All right, next up, article on the jobs numbers. U.S. jobs juggernaut rolled on in November. Non-farm payrolls up 263,000. The U.S. labor market juggernaut refused to slow down in November as job creation held up despite increasing signs of layoffs across the economy. Non-farm employment grew by 263,000 in the middle of the month, well above the 200,000 consensus forecast. October numbers was also revised up 23,000 to show a gain of 284,000. The payrolls gain was only one element of a report that signaled ongoing tightness throughout the labor market. Average hourly earnings rose by 0.6% to push annual earnings growth back up to 5.1%. Here, too, October's data was revised up from an initial estimate of 0.4% to 2.5%. Moreover, the buoyant jobs market gain again failed to lure sideline workers back to the labor force. The participation rate fell to 62.1% from 62.2%. That's a big problem. We need to get more people in the workforce and make them productive as opposed to sponging off the government. The numbers vindicated the fears of those who see the U.S. economy as increasingly held back by shortages of workers. Quote, increasingly, I fear we are moving to an environment where labor is short, not long, end quote. Richmond Federal Reserve President said in a speech prepared before the release, quote, labor supply looks like it will remain constrained, end quote. The numbers hurt hopes for a quick end to interest rate increases by the Federal Reserve, which had risen in recent days as Chair Jerome Powell repeated that the central bank's next step will likely be smaller than 75 basis point increases seen at each of the last four meetings. Analysts said the report made it more likely the Fed would have to continue tightening policy to tame inflation, even at a cost of a recession. Quote, I was allowing myself to get more hopeful about a soft landing, but this pretty much dashed that hope, end quote, tweeted Peterson Institute fellow Jason Furman, pointing to a big upward revision in hourly earnings in both of the last 2 months. That, together with a picture of slowing productivity growth, suggests that the labor market is still generating plenty of inflationary pressure, he argued. Quote, you probably want to revise your views on inflation and its overall dynamic more based on today's jobs report than any other data report this entire year, and not in a favorable direction, end quote, Furman said. On a sectorial breakdown, there were big gains in employment in the hospitality and leisure sector again, with manufacturing and construction also continuing to trend up. However, there were also increasingly visible pockets of weakness in consumer-facing sectors at the start of the key holiday season, with retail, transportation, and warehousing all shedding jobs. Quote, retail hiring has been much lower so far this holiday season compared to any year in the 2010s, end quote, said Daniel Zhao, chief economist with Glassdoor. So, some things are good. Some aspects of the economy are still chugging along. Others, not so much. All right, last article here, just some food for thought. It has to do with Social Security. Who has better ethics, the Social Security system or Bernie Madoff? And with what's going on with FTX, this is kind of apropos. All right, let's dive into this. This was written by Patrick Barron, and this was posted on MisesWire at Mises.org. According to Wikipedia, Bernie Madoff ran the world's largest Ponzi scheme. The losses were estimated to be as high as $65 billion. Madoff had promised to invest his customers' money in productive enterprises and pay them generous returns, when in fact he spent the money and manufactured fake statements. His concerns to his customers were funded with money from new customers. The scheme collapsed when money from new entrants slowed down. There were no productive investments to use to pay off his customers. Like Madoff's scam, Social Security is a vast Ponzi scheme. Although the program claims to have assets close to $3 trillion, these, quote, assets are not productive assets such as factories, farms, or valuable commodities. They're only book entries and differ little from what Bernie Madoff was reporting to his customers. The government has spent the accumulated taxes of 8 years and now pays out what it receives in monthly taxes to retirees. According to some fiduciaries, soon monthly taxes will not cover retiree benefits. This could spell big trouble for Social Security, and this is something that I worry about for my older clients. The main difference between Madoff's scam and Social Security is that all of Madoff's victims gave him their money voluntarily. They were victims, of course, but no one forced them to give Madoff their money. Many may have been gullible, avaricious, or both, but they participated in Madoff's plan with their eyes wide open and were not coerced into doing so. They're now receiving nothing, and their initial investments are gone, probably never to be recovered or only partially, after many years of legal machinations. Compare Madoff's scam with Social Security. All who earn incomes, whether wages or personal profits, are required by law to pay into the Social Security system. Failure to do so will result in fines and possible imprisonment. Like in Madoff's plan, all participants in Social Security receive periodic statements showing how much they and their employers have contributed, as well as participants' anticipated monthly payout upon retirement. The main difference between the Madoff scam and Social Security is not that Social Security has accumulated real productive assets, while Madoff's scam did not. Social Security does not own productive assets. The main difference is that Madoff did not force his customers to join his scam under the threat of violence, whereas that is exactly what the Social Security system does. Therefore, if any system can be considered more ethical or perhaps less unethical, it is the Madoff scam. Madoff was a confidence man, but he did not force anyone to join his scam. Targeted investors could join or not join, but that definitely is not the case with Social Security. Yet Madoff is a modern pariah, and Social Security is lauded by many as the savior of the impoverished elderly. Well, I don't think that's going to work out in the long run. If both systems are Ponzi schemes, why was Madoff jailed and not the lawmakers and the administrators of Social Security? If the Madoff plan can be shut down unceremoniously, why can't Social Security be shut down just as unceremoniously? The answer most people give is that they were forced into paying it for someone else's benefits, so someone else should do the same for them. Well, that doesn't seem quite fair. In other words, since they were victims, they have the right to victimize others. I consider this a very common response to be highly unethical. At some point, the Social Security Ponzi scheme must end, and when that happens, some will lose. Would a victim of the Madoff scam feel justified in allowing the scam to continue just because he was a victim himself? I think not. Likewise, Social Security recipients have no ethical leg to stand on. Neither do those who have been forced to pay into the Ponzi scheme for many years and have yet to receive any payouts. Being a victim certainly does not make it ethical to victimize someone else. Therefore, the only ethical thing to do is end Social Security right now. No more checks, no more taxes, fire all the employees, destroy all the records, sell all the buildings and office equipment, cut out this unethical financial cancer that will destroy the body politic. And I could totally agree. I think a nice way to make the people whole who have been paying into the system, like myself, since, I guess, 1989, when I got my first job as a 15-year-old. How about start selling off the assets of the federal government? I'll take 1,000 acres in Rocky Mountain National Park. I could build a beautiful house there. And, to me, I'd call it even. Other people, maybe they want cash. Maybe they want gold. Maybe they like the USS Missouri that's in Pearl Harbor. There's an idea. So there's ways. Or here's another thing. Maybe jail the politicians who have been robbing us blind all these years, and seize all their assets and liquidate those to give out to the people who've been robbed at the point of a gun over the last 30, 40, 50 years. So anyways, those are just some creative ideas. If you have some ideas, send them in, shoot me an email, let me know. All right. Well, that's everything I had for today. I hope everyone has a fantastical weekend. If anyone needs anything from me, please go to dsafinancialgroup.com. My email is right here below my beautiful face right here on the screen. So if you want to shoot me an email, feel free to do so. Also, my website, my phone number, and you can book a meeting if you want to get your financial planning back on track. Please do so. And hope everyone, like I said, has a great weekend. And I'll talk to you next time. Adios.